Investing in the stock market can be a little frightening for a lot of people, since we always hear from TV or the internet about market crashes, depression, and recessions. But yet, the majority of wealthy people still invest their money in the market. So today, we're going over some of the most common mistakes investors make and the main principles that rich and intelligent investors use. Many people invest based on speculation. Here, investors focus on short-term gains made possible by market fluctuations. For example, if there's a rumor that Apple might be coming out with their hottest technology yet, many people might be motivated to buy lots of Apple stock. This sort of investment is based on speculation and can create Apple's share price to fluctuate and become a little more volatile, because following a rumor can make people become eager to buy Apple stock, which might increase the price of the share and create a bubble. If they're lucky and the rumors are true, other investors might jump in and drive the price of the share up. And those who jumped at the beginning of the trend might end up making some fast cash, while later investors might lose their money when share prices drop to normal. But if the rumors are wrong, investors begin pulling back their money, bursting the bubble, and losing money. An intelligent investor will buy stocks based on the pricing versus value, and not speculation. When the pricing of the stock is below the intrinsic value of the company, their investment has great potential for growth. For example, Warren Buffett bought American Express stock when a large salad dressing company failed to pay its debts. American Express lost half of its share value, but the company was still functioning the same. It simply took a financial loss. Buffett saw that the share value was very underpriced, so he decided to buy $13 million worth of stock. Today, that investment is worth over $7 billion. Intelligent investors like Warren Buffett use analysis instead of speculation. There are 3 principles that apply to all intelligent investors. First, an intelligent investor analyzes the long-term development and the business principles of the company before buying the stock. A stock's long-term value is not arbitrary. It depends directly on how well the company behind the stock performs. Intelligent investors examine the company's financial structure, their leadership structure, and whether it has a good history of distribution of profits to investors. Intelligent investors do not fall into the trap of only looking at the company's short-term earnings. They pay attention to the company's whole financial history. This gives investors a better idea of how well the company is doing, completely independent from its value on the market. For example, this company is not currently popular, so it has a lower share price, but their records show good and consistent profits and has a strong infrastructure. The company is likely to be undervalued and therefore likely to increase in share price in the future. Second, an intelligent investor makes it a priority to protect themselves against any serious losses. They do this by creating a diversified portfolio. A great example of this is one of the best investors in the world, Ray Dalio. He diversifies his portfolio so well that even in the 2008 market crash, when most investors were losing upwards of 50% of their money, he only lost 1.8%. As Warren Buffett says, do not put all of your eggs in one basket, no matter how promising it appears. If you diversify, even if one investment does not do well, the rest of the investments offset the losses, and the overall portfolio won't suffer as much. And third, intelligent investors understand that in many cases, they won't generate extraordinary profits, but rather safe and steady revenues, because aiming for fast money and short-term gains comes with a lot of risk of losing money, and that is something they do not like to do. In the book Money Mastered the Game, Tony Robbins interviewed 50 of the best investors in the world, and something that they have in common was that they are all passionate about not losing money. Not only that, but they try to look for ways to make as much return with the least amount of risk. Benjamin Graham says the first thing to do before investing isn't to look at the stock's history. Sure, that's important, but it's more important to look at the history of the whole market. If you look back through history, the stock market has been defined by regular ups and downs, but often the fluctuations in the market can be very unpredictable. For this reason, smart investors need to be prepared both financially and psychologically. Economic crashes like the Wall Street crash of 1929 or 2008 are unfortunate, but certainly a repeating cycle that will continue to happen. This is why a diverse portfolio is so important, so your investments don't get hit all at once. What's more, investors need to be mentally and psychologically prepared for a crisis, because if they don't, they might end up selling when the market is down, locking in their losses. But by looking at the history of the market, we learned that even after the most devastating crashes, the market always recovers. Something that Graham emphasizes is that intelligent investors do not follow the crowd. Sometimes the market is too optimistic and makes investors see profits that aren't really there. Or sometimes the market is too pessimistic, telling investors to sell everything. This is crowd behavior. When things are going up, people start investing because it seems like everything is going well and everyone will make money. This causes more people to invest more money. Eventually, shares become unrealistically overpriced to the point where an unsustainable bubble in the market is created. Take the dot-com market bubble in the early 2000s. The internet became the sensation, so investors put a lot of money on pretty much any tech company with a pulse. But many companies didn't have the structure to become profitable. And when investors started to see that, they tried to pull their money out and the bubble was burst. And many investors lost their money. So intelligent investors do not follow the crowd. Now, when it comes to investing, there's a couple ways to do it. You can be a conservative investor, or you can be a more aggressive investor. Conservative investors typically have half of their investments in safer, less profitable asset classes, like government-issued bonds, and the other half in well-established stocks. Very conservative investors go up to 75% in safe, less profitable assets, and 25% in more aggressive assets. I've covered these asset classes in more detail in some other videos, so if you like a refresher, make sure to check them out at the end of this video. Now, many investors use the dollar cost averaging strategy, which means that they set up a specific amount of money they will be investing on a regular basis. For example, investing $300 every month. With this strategy, you invest the exact same amount of money no matter what the market is doing. If the market is up, you will invest $300. If the market is down, you still invest the same $300. This strategy helps you limit volatility because when you invest in both weathers, when the market is up or the market is down, the value averages out and you have a steady growth following the market. As a conservative or passive investor, you can actually set up your investments on autopilot. You can commit yourself to an amount to be taken out of your bank account directly to your investments portfolio. And from time to time, you should check your investment ratios. Typically, your more aggressive investments might grow faster than your less aggressive ones, so your 50-50 ratio might get a little off. So from time to time, you will need to transfer funds from one side to the other. And this is what is called balancing your portfolio. More aggressive investors employ the same strategies as conservative investors do, but they tend to split their ratios more favorably to stocks, which they have more potential for growth but tend to be riskier. In addition to bonds and well-established stocks, they might experiment with higher risk and higher reward investments, like startups. Graham recommends that no matter how exciting and promising an investment opportunity seems, aggressive investors should limit these stocks to a maximum of 10% of their overall portfolio, for the same reason we mentioned before. An intelligent investor limits his chances of a major financial loss. Investing can be a little confusing, but understanding the basic principles, you can be on your way to become an intelligent investor.